Alright, so you've got a spare $1,000? That's amazing. Most people never even get to this point, so give yourself some credit. Whether you saved it up from your first job, a side hustle, or maybe it was a gift or a tax refund, having $1,000 in your hands is a huge milestone. It's more than just a number. It's a symbol of your ability to take control of your financial life. Now, a lot of people might look at that amount and think, is this really enough to make a difference? The truth is, many believe you need tens of thousands to start investing or building wealth, but that's simply not true. In fact, the first $1,000 is often the hardest to save, and it's the most important. It's the foundation for everything that comes next. That first thousand is your ticket to making your money work for you. Think of it as your golden ticket, a pass that opens the door to opportunities you might not have considered before. It's not just about having cash, it's about what you can do with it. Imagine planting a seed. With care and patience, that seed can grow into a strong, healthy tree. Your $1,000 is that seed. It's the start of your journey toward financial freedom, and with the right moves, it can grow into something much bigger over time. Think of this money as a powerful tool you're about to put to work. It's not just sitting there, it's ready to help you build, create, and secure your future. Every dollar is like a tiny worker, and together, they can accomplish a lot if you give them the right job. But here's the catch. In 2025, prices are rising faster than ever. Inflation is making everything from groceries to gas more expensive. If you just let your money sit in a regular savings account, it's actually losing value every day. That's because the interest you earn is usually much less than the rate at which prices are going up. So if your money is just sitting in a savings account, it's quietly shrinking. You might not notice it right away, but over time your purchasing power goes down. That's why it's so important to make your money grow faster than inflation. Investing is the way to do that. When you invest, you're giving your money a chance to grow, to multiply, and to outpace inflation. Even small amounts, when invested wisely, can turn into much larger sums over time thanks to the power of compound growth. Now let's be clear. This isn't about getting rich overnight. There are no magic tricks or shortcuts here. It's about making smart, steady moves that secure your future. It's about building habits and a mindset that will serve you for years to come. The good news? Investing in 2025 is easier than ever before. You don't need to be a Wall Street expert or have a finance degree. With just a few taps on your phone, you can start investing in stocks, ETFs, or even fractional shares. Technology has made it accessible to everyone. All you really need is the decision to start. There are tons of free resources, blogs, and videos to help you learn the basics. You can start small, learn as you go, and build your confidence over time. The most important thing is to take that first step. Think of that $1,000 as your entry fee into the world of investing. It's your ticket to a new way of thinking about money. And I'm here to guide you through the process step by step so you can use it wisely and avoid common mistakes. The key is to change your mindset. Instead of thinking about what you could buy right now, a new phone, a weekend trip, or the latest gadget, think about what this money could become if you invest it. Delaying gratification now can lead to much bigger rewards in the future. This is about your future self. Imagine looking back in 5 or 10 years and thanking yourself for making this choice. It's about creating financial peace of mind, knowing you took action to secure your future. By investing, you're essentially paying your future self first. You're making sure that you'll have options, freedom, and security down the road. It's one of the smartest moves you can make, no matter your age or background. Every dollar you invest is like laying a brick in the foundation of your financial house. It might not look like much at first, but over time, those bricks add up. You're building something solid, something that can support your dreams and goals. This is your first step toward taking control of your financial destiny. It's the moment you stop letting money control you and start telling your money where to go. The choices you make now will shape your future in ways you can't even imagine yet. And here's the best part. It's simpler than you think. You don't need to be perfect, you just need to get started. Small, consistent actions are what lead to big results over time. So, let's break down exactly how you can turn that $1,000 into something much bigger. We'll look at practical steps, smart strategies, and common pitfalls to avoid. You'll learn how to make your money work for you, not the other way around. Remember, this is just the beginning. Every journey starts with a single step, and your first $1,000 is that step. Stick with it, stay curious, and you'll be amazed at what you can achieve. It's going to be worth it. Before you even think about investing your hard-earned money, take a moment to reflect. Ask yourself some important questions that will shape your entire financial journey. The first and most crucial question is, what is this money for? Are you hoping to buy your first home, build a comfortable retirement, fund your child's education, or maybe start your own business someday? Your answer to this question will influence every decision you make from here on out. Each goal comes with its own timeline and level of importance. Maybe you're a young couple dreaming of a new house, or perhaps you're planning for retirement decades down the road. You might even be saving for a once-in-a-lifetime trip or to support a loved one's education. Identifying your specific goals helps you prioritize and stay motivated. Remember, your approach for short-term goals, like buying a car next year, will be very different from your strategy for long-term goals, such as building wealth for retirement. Short-term goals require safety and liquidity, while long-term goals can handle more risk for potentially higher returns. Knowing your why is critical. It acts as your financial roadmap, guiding you through tough decisions and keeping you focused when distractions arise. When you're clear about your purpose, you're less likely to make impulsive choices. Next, consider your time horizon. When will you need this money? Is it in a few months, a few years, or several decades? The answer will determine how much risk you can afford to take and which investment vehicles are most appropriate. For short-term goals, it's wise to be conservative. High-yield savings accounts, certificates of deposit, or bond funds can help protect your money while still earning some interest. The key is to avoid unnecessary risk when you'll need the funds soon. For long-term goals like retirement or building generational wealth, you can afford to take on more risk. Investing in stocks or diversified funds can offer greater growth potential, and time is on your side to recover from market ups and downs. Historically, markets have risen over time, rewarding patient, long-term investors. This is why understanding your time horizon is so important. It helps you stay calm during market volatility and stick to your plan. But before you invest, ask yourself, how comfortable are you with risk? How would you react if your investments temporarily lost value? Your risk tolerance is personal, and it's okay to be cautious or adventurous. What matters is being honest with yourself. There's no right or wrong answer here. Some people sleep better knowing their money is safe, while others are willing to ride out the ups and downs for higher potential returns. If you're unsure, consider talking to a financial advisor for guidance. Ultimately, the key to financial success is matching your investments to your unique goals, time horizon, and personality. When your strategy aligns with your life, you're more likely to stay on track and achieve the future you envision. Let's talk about a term that could change the way you think about investing: index fund. If you're new to investing, or even if you've been around the block a few times, understanding index funds is one of the smartest moves you can make for your financial future. When you're deciding where to put your first $1,000, index funds are often considered one of the best starting points. Why? Because they offer a simple, effective way to grow your money without needing to be a stock market expert. An index fund is a type of investment that holds all the stocks in a specific market index, such as the S&P 500. This means, instead of buying individual stocks and trying to guess which ones will perform best, you're investing in a broad cross-section of the market all at once. With just one purchase, you instantly own a small piece of hundreds of companies, including giants like Apple, Amazon, and many others. This is called diversification, and it's a key principle in reducing risk while investing. Instead of trying to pick the next big winner, you're betting on the overall growth of the market. Over time, markets have historically trended upward, rewarding patient investors who stick with their investments through ups and downs. If you look at the data, investing in a broad market index has been a solid strategy for building wealth over the long term. Even when the market dips, it has always bounced back and continued to grow. Another huge advantage of index funds is their low cost. Because they're passively managed, meaning there's no expensive team of managers picking stocks, fees are much lower than with actively managed funds. Lower fees might not sound exciting, but over years and decades, they make a massive difference. The less you pay in fees, the more of your money stays invested and has the chance to grow. For beginners, a total stock market index fund or an S&P 500 index fund is a fantastic choice. These funds give you exposure to a wide range of companies, making your investment more resilient to market swings. You can buy index funds easily through major brokerages like Vanguard, Fidelity, or even through your bank's investment platform. The process is straightforward, and you can start with just a small amount of money. Once you've set up your account, you can automate your investments, making it even easier to stay consistent. Just invest regularly, sit back, and let your money work for you. That's why index funds are often called the ultimate set-it-and-forget-it investment. For beginners and experienced investors alike, they offer a stress-free way to build wealth over time, so you can focus on living your life, knowing your money is growing in the background. Let's talk about ETFs, exchange-traded funds. ETFs are similar to index funds, but trade like stocks. They offer diversification and flexibility. Buy and sell ETFs anytime during the trading day. For beginners, a broad market ETF like VOO or VTI is ideal. ETFs and index funds both offer low-cost diversification. ETFs are popular for their ease of trading. Start your investment journey with a single share of an ETF. Picking individual stocks is exciting but risky. The dream is finding the next big company, but it's tough. Many fail at picking stocks, even professionals. If you invest in one stock, you're not diversified. A single company's trouble can have your investment overnight. If you must try, use a small portion of your money. Research well, but don't risk your entire $1,000. Diversification through index funds and ETFs is safer. Cryptocurrency is the wild west of investing. Bitcoin and Ethereum offer potential but are highly volatile. Prices are driven by hype, not fundamentals. Crypto can double in a week and crash the next. It's the riskiest asset class filled with scams. Be prepared to lose everything if you invest in crypto. Treat it like a lottery ticket, not a serious investment. Use a tiny fraction of your money, if at all. Focus on proven, diversified investments like index funds. Ready to invest? Here's a step-by-step guide. Step 1. Open a brokerage account with a reputable firm. Vanguard, Fidelity, or Schwab are great for beginners. Step 2. Fund your account with your $1,000. This is your investment capital, ready to work for you. Step 3. Choose a low-cost index fund or ETF. Buy it through your brokerage's website or app. Enter the amount and place the order. Congratulations, you're now an investor. Avoid common beginner mistakes. Don't try to time the market. Stay invested. Checking your portfolio too often leads to rash decisions. Set it and forget it for long-term success. High fees erode returns. Choose low-cost funds. Diversification protects against single company failures. Stick to your strategy. Avoid hot stock tips. Consistency and patience are key to building wealth. You've invested your first $1,000. Now make investing a habit. Automate regular contributions to your brokerage account. Dollar cost averaging buys more shares when prices are low. Consistent investing builds wealth over time. Patience is crucial. Investing is a long-term game. Market downturns are normal. Stay the course. Your future self will thank you for your consistency. Start now. The best time to invest is today. Plant the tree that will provide financial shade. Be patient and watch your investment grow.